Come on, man. Oh my gosh. Well, I guess I'm not going in the pool this morning, so why don't we watch the video I just made? Two traders can take the same setup, same chart, same entry area, same opportunity. One follows the plan, one starts making adjustments. Same market, different outcome, and that's where trading gets uncomfortable. The difference is not always the strategy. Sometimes the difference is who still has control once the trade starts moving. Two traders can trade the same strategy and get completely different results. One follows the structure, the other starts improvising. Now, most people assume the difference is skill. Better chart reading, better instincts, better timing, but that is not usually where the real separation happens. The real separation happens after entry, when the trade is live, when money is moving, when pressure shows up. That is where one plan beats the other, not because it was more complicated, because it survived contact with pressure.
You made it. You made it survive the pressure.
I thought that was pretty funny. The market does not care how good your plan sounded before your entry. The only thing that matters, whether you can execute it or when the trade is working against you, teasing you, or paying you less cleanly than you expected. I mean, you have the same structures, same setups, same conditions. Two traders can see the same opportunity and still produce completely different results. Before entry, everyone can sound disciplined. Everybody can sound like they know what they're doing. Everybody has a theory or whatever. From the scammers to the pros that stick to their back-tested plans, everyone can sound disciplined before the entry. The rules are clean, the risk is defined, the target makes sense. But once the trade starts moving, pressure starts asking questions. Pressure starts asking the trader questions. Do you move your stop? Do you still trust the target? Do you still trust your size? Do you still trust the structure? That's where the plans fail, not on paper, inside the trade. The break usually does not happen at entry because entry feels controlled. Entry feels intentional. Entry feels like the trader, it feels like the trader is in command. The breakdown happens after. When the trade moves against you, or when the trade moves in your favor, but not fast enough, or when it gets close to target and then it starts pulling back. That is where the decision changes. The trader is no longer asking, what does my plan say? You have the best plan in the world. If you ignore it, even if it's the worst plan, you're never going to know if you keep ignoring your plan. What does my plan say? Now the trader starts asking, what can I do right now? What can I do to feel better right now? Because, you're losing money, you're panicking, you're sweating, whatever. You want to feel better about what's happening. And that's where the damage starts. Cut early, hold too long, move the stop, change the size, override the structure. Each one feels small in the moment. Each one feels explainable. Each one can be dressed up as judgment. But every one of those decisions, they change the trade. You're no longer trading the original plan. You are trading a new version created under pressure. And that new version has a cost. It has a dollar cost, a risk cost, and a consistency cost, whether you track it or not. The trader who wins does not avoid pressure. They expect it. See, that's the difference. They know the trade will not feel perfect. They know the market will test the plan. They know there will be a moment where emotion offers an easier answer. Take the profit now, give it more room, add size, exit before the target. And let me say, for me, a target would be like a stop loss or a rolling point. So I know target means different things for people. They might say something like, ignore the rule just this once. But when that moment comes, they do not negotiate with the trade. They execute. Same stop, same target, same structure, same risk. That does not mean every trade wins. It means the process stays intact. Did you get that? It means not every trade wins, but the process stays intact. I like this guy. I like me. And when the plan is valid, that is what allows the edge to show up over time. Not because the trader predicted it perfectly, not because they felt confident the whole way, because the process held when pressure tried to take over. That's the difference between having a plan and having a plan that actually runs the trade. And let me just say, if you have a bad plan and you don't stick to it, you'll never get the data that says, hey, that's a bad plan. And if you have a good plan and you never stick to it, or you alter your plan along when the emotions kick in, you won't have the gains that you should get. So let me give you a losing example. Here's a big one here. Let's look at arch egos, and I may be saying that wrong, but it's not an English class, so whatever. Arch ego's capital management collapse. Bill Huang, he had a defined approach in his trading.
He said Wang. He said Wang.
Highly concentrated positions using leverage through total return swaps. A total return swap is a contract. It lets the trader get the gains and losses of a stock without directly owning the shares. Now, the bank holds the position and the trader gets the exposure.
That sounds insane to me.
That structure can create massive leverage. It's small capital, huge exposure, and when the trade works, leverage makes the gains look powerful. But when the trade moves against you, leverage does not negotiate. I repeat, leverage does not negotiate. This is where the alarm should go off. Anyways, leverage, it amplifies the damage. When those positions started moving against him, pressure entered. Losses began to build. At that point, the rule that mattered most was risk control. Reduce exposure, contain the downside, cut the position before the position controls you. Instead, positions were maintained, leverage remained high, and no meaningful reduction. Risk was not cut, and when prices continued to lower, forced liquidations followed. Over $10 billion was lost in just days. That was not a strategy failure alone. That was a failure to control risk under pressure. The market moved, pressure showed up, and the risk structure did not hold.
You remember seeing that slide?
Let's look at a winning example. Let's look at Stanley Druckenmiller during the early 1990s currency trades. Okay, he had a structured view on the British pound. The plan was clear: short the currency with defined risk. As the trade went on, pressure showed up. Large position, he had global attention, massive capital at stake, and when the trade gets that big, pressure does not disappear because the idea is good.
Okay, that last slide, it might be a little bit much for the children.
So there are opportunities to over-adjust, to second guess, to take profits too early, to reduce the position because the size feels uncomfortable, to react to every headline. Think about that. Think of the focus on this in the trading community, the global trading community. So he to start managing emotion is one of the things that, how do I manage my emotion instead of managing the trade? See, he did not. He stayed aligned with the structure, maintained position sizing within his framework, executed the plan. And that discipline contributed to one of the most profitable currency trades ever. Same pressure, different response, different outcome. And that's the point. The market creates pressure for everyone. The difference is whether the trader's structure still has authority when that pressure appears. Let me tie it back to you now. This is where it becomes real. You do not need a better setup to fix every trading problem. You hear me? Sometimes the setup's fine. Sometimes the strategy is good enough. Sometimes the problem is what happens after the trade starts.
It doesn't have to be pressure. It could just be carelessness. You could just be stupid. It's not always pressure that messes up the plan.
You need a plan that you can actually follow. And you need the ability to follow it when it matters. Not when the trade is calm. Not when the candles look clean. Not when the profit is already obvious. When the trade is testing you, because every time you override the structure, you change the trade. And when you change the trade, you change the risk. When you change the risk, you change the math. And when you change the math often enough, the outcome changes too. It's got to, because it's math-based.
Sasquatch and that girl, they get it.
You have already paid for this behavior. You've paid for it in early exits. You've paid for it in oversized losses. You've paid for it in trades that should have been winners but were cut before the plan had time to work. You've paid for it in losses that were supposed to be controlled but became larger because emotion got permission to edit the trade, and you gave the emotions the permission. If this continues, the outcome does not change. The market will charge you tuition whether you want it to or not. The question is whether you learn from it. Inside every trade, there are only two forces: the structure you define before the trade and the decisions you make inside of that trade. One is planned, one is reactive, one is built before pressure, and one is created because of pressure. One protects the process, and one tries to protect the feeling. One of them takes control, and whichever one wins determines the outcome. That is why Trader Gauge focuses on execution discipline, because a plan does not beat another plan because it sounds better. A plan wins when it still controls the trade after pressure appears.
I don't know why he didn't just mention going to tradergauge.com.
Run the Trader Gauge Execution Diagnostic. The link is in the comments. It's designed to help you identify where your execution tends to break down under pressure. And after the diagnostic, there's also a structured tool called the Trader Gauge Pressure Protocol Kit. It's a mouthful, I know, but it's for traders who want to improve execution discipline. Check it out.
That right there was the product pitch. $49, and it's one time. It's not $49 a month. You pay it one time, you get the pressure protocol kit from Trader Gauge, and you use it as long as you want to use it.